So what documents do you need to start selling your business? So the first thing your M&A advisor or business broker is going to ask for is some of your basic financial information. They're going to want to come up with a general assessment of the valuation for your business, what you're going to sell for, and determine if that's an amount that is going to work for you. So they don't want to start the process if, say, the business is likely to sell for $2 million, but you say, I don't want to do this unless I get $6 million. Because then obviously you don't want to start the sales process. You're going to need to go through a different process. You're going to need to go through a aggressive sales and marketing campaign to grow your business if you want a $6 million valuation. So in order to do this, the first thing they're going to need is your business tax returns. And your business tax returns are really the most important documents because buyers and lenders, that's what they're going to believe are your true financials. That's the true financial picture. That's the one that you swore to the IRS to be accurate and true. So if you are keeping two sets of books, you should stop because that kills the value of your business because the buyers are going to use your tax returns, not your financial statements. And it's a big red flag to buyers if the tax returns and the P&L don't align. So in addition to your tax returns, they're also going to want to see your interim profit and loss statement. So that's just the profit and loss since you filed your last tax return, so that we can see how the business is currently trending. Now, I'd say 99% of brokers, what they're going to do is they might take that partial year and annualize it. So let's say we're 3 months into the year, they'll multiply your numbers by 4, and then they'll advertise your business as if that's how much the business makes, which that way is completely wrong. Even though most people do it, it misstates the earnings power of a business that is, say, seasonal, which almost every small business has some level of seasonality, meaning you make more in the spring than you do in the winter, or you make more in the winter than you do in the spring. So annualizing just a portion of the year isn't going to work. Good advisors are going to look at a trailing 12-month period to see what the current state of the business is. And that way you can see if the business has grown since you filed the last tax return. That means you can get some credit for that growth, and it accounts for that seasonality. And that trailing 12-month number is going to be a big factor in determining the valuation for your business. Now, the next note is that when we're looking at these financial statements, whether it's the tax return or those interim P&Ls, we're not necessarily using the bottom line net profit to value the business. What we're going to use is the cash flow. So the way we're going to figure that out is we're going to take that bottom line net income, we're going to add back expenses like interest, your salary, and then we're also going to add the non-cash expenses like depreciation and amortization to that bottom line net income number, and that's going to give us the cash flow or the seller's discretionary earnings, SDE, and then that number is going to be used to value your business. Now, if you do have a larger business, your business will likely sell on a multiple of EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This is very similar to the SDE number. It just doesn't include your salary being added back. And the reason that's used in larger businesses is really at some point your salary just isn't that big of a portion of the earnings, so it becomes more relevant to just look at EBITDA. So if you need help with this initial assessment of what you could get when you go to sell your business, just check out the link in our bio and we can help and give you a free idea of what your business might sell for.